Hey guys, I'm back. Sorry I have not uploaded a content for 2 weeks now. My cousin got married and after that I had people over, so I can't really create content at that time. Anyway, as promised, from now on we'll be looking at stocks through our 5 metric analysis and we'll be looking at other financial ratios and metrics I personally look out for. Anyway, today's video will be about Netflix and the now almost 30% drop pre-market due to subscriber loss, but is it really that bad? Let's look at their earnings, the top line, and the bottom line. This is their revenues of last year, 2021. Q1, Q2, Q3, Q4 revenues, top line, and EPS bottom line. They were expected to deliver 7.929 billion in sales and 2.9 EPS. If you compare that to Q1 in 2021, to the estimates, they're expecting a revenue growth while a decrease in the EPS. Actually, that's 10%, 10.69% revenue growth, and 22.67% loss in EPS. I think just from these numbers, the stock price is really expected to drop, whether they're in line with the expected earnings. Again, this is the analyst estimates, 7.929 billion, and this is mine, 7.163. As you can see, it's the same as the Q1 reported results. I don't really expect them to grow, I just want them to have the same revenues and EPS. But after hours, they reported 7.868 billion in sales and EPS of 3.53. This is shy from the analyst revenues estimates, but still the EPS is higher than the expected EPS. Although it is still short of the Q1's reported EPS, right? From 3.75, it's now down to 3.53. All in all, if you ask me, it's not that bad. But again, we have to look forward. Them losing subscribers is of course an issue. But to me, the revenues remain strong. Their financials remain strong. The drop to me is a multiple compression. People taking profits because it's trading at a growth multiple. But then maybe people think that, maybe it's not growing as they like or as they expect them to grow. They even said that themselves, the company, they said that to their shareholders. Now, let's look at their financials. Let's look at the best price we can buy Netflix. Current price is $348.61, but when the market opens, it will be at $250. High price of $700, that's 50% from this current price. Metric 1, we want an EPS multiple lower than 3, it's 2.9. This is good, meaning the EPS is high enough for the price we're paying the stock for. EPS is growing nice, although OSN is increasing. Not good, but they're growing, so I guess I'm okay with that. Second metric, this is their financials. The revenues, the costs and expenses, the net income, and free cash flow. The above values are in billions, below are the margins. This is basically everything divided by the revenues. It's the same as before. If you've been watching my videos, what I did here is just, I added the trailing 12 months and the 5 and 10 years average margins. So if you look closely, I hate Netflix because they're a negative cash flow company. This is not good if you're a value investor, but I still see Netflix 10 years from now, probably 20 years from now. This shouldn't be a problem going forward, but for now with these numbers, we really shouldn't be paying premium for the stock. We want to pay $1 or less for 1% of their lowest margins, meaning we want to pay 1 PE or less for 1% of their margins. With 17.23 here, that's not even the lowest margin, but I really can't use anything here but this. Look at this. This is negative 4, 5, 6. So at 17, I'd say we're still paying premium. 1.9 is our discount. This is a premium. 1.9 times, we're paying almost 2 times their margins if we buy at these prices. Now, this is what I added, the third and the fourth metric. Third metric is price to free cash flow metric. Basically, the free cash flow divided by the current market cap. But then again, their trailing 12 months cash flow is negative. So what I did here is I used the 2020 free cash flow of 1.929 billion. The price to free cash flow is 80.23. It's very high, very expensive. Inverse of this is free cash flow to price. This should be 5 because I want the price to free cash flow metric to be below 20. It's 80.23, so it's very high, By this metric, we're paying less for their price to free cash flow, but again, the price to free cash flow is too high. That's why it's trading at a discount compared to that metric. But then again, the price to free cash flow is too high. I wouldn't really buy Netflix for this metric just because, it's 80.23. It's very high. Fourth metric is for stocks paying dividends. Netflix doesn't pay dividends, so we don't have values to put here. Fifth metric is historical PEs. It's trading at a discount now, only because it's been trading at high PEs then. 57, 127, 688. This is the key financial metrics and ratio I personally look out for. The cash, free cash flow, and long-term debt, PB ratio, current ratio, etc. PB ratio is 9.77. I seriously don't have a threshold for this metric, but we want this as low as possible. At 9.77, I'd say it's still a bit high for me. So PB ratio is total equity divided by the current market cap. Next is current ratio. This is the current asset divided by current liabilities. Current ratio, we want this higher than 1. If you ask me, I'm more concerned about the current ratio than the long-term debt. With their cash, they're basically debtless in 2.43 years. In conclusion, Netflix is still overvalued from my entry prices and from these metrics. I'm only a buyer of Netflix below 200, and if I'm gonna be honest, that still is not a value play. Negative cash flow, they still need to grow their revenues more, but with a lot of competition, it will be very hard for Netflix. I'd start a position at 200, maybe $150 to $180. So yeah, you have to understand that stocks trading at high multiples will do this, plunging down 40-30%. It happens when certain analysts' estimates are not met. That's why I don't buy stocks at premium. Buying stocks like this, growth stocks, are trade plays. If your brokers don't offer extended hours, try to stay away from high multiple stocks like this. At 250, pre-market open price, Netflix is still expensive. If I were you, I'd buy below 200, probably 180. That could be a value play.